Hello, this is the Oak Bloke, and I'm going to be talking about SDCL Energy Efficiency. So this is none of this today is going to be advice. You make your own investment decisions. This is an article that is going to be published on my Substack. My Substack being the Oak Bloke.substack.com. This is one of 615 articles that you'll find there, and this one is about SDCL Energy Efficiency, ticker SEIT. So as you can see here, the article is titled "An Onyx Day's Work for Higher Profits." And it relates to this news that came through today. So we're going to deep dive into this. What do I think it means? I'm not connected with this company. I'm not connected with any of the companies that I talk about on my Substack. I am simply a private investor, and you're watching this just out of entertainment. What I would say though is on my Substack, if you like what you watch and like what you see, that there's this opportunity here under Help Emmaus to help Emmaus. And this is a fundraise that I've done. 116 people have supported Emmaus, and you can see here, they find that there's fun ideas and great work and so on. So look, um, I don't do this for any personal gain other than the feeling that I'm making a difference for this charity that does a lot of good work. So it helps a lot of it helps people who are ex-homeless, because by definition, if you put a roof over their heads, they're no longer homeless. But it's all about helping people help themselves. So the people that the colleagues that join Emmaus. Sorry, I keep mispronouncing it. It is Emmaus. One of my readers corrected me and said, "You're mispronouncing the charity that you're trying to raise money for." So I said, "Oh well, uh, I'll make a mental note to never do that again," and I just did. So there we go. Apologies. Anyway, enough of that. Yeah, it's there if you would and could help. Really appreciate it if you did. So yeah, this is sort of an imaginary Onyx type of solar panel that doesn't exist. It's just a bit of fun. But this is a happy customer using an Onyx solar panel, because this is what these guys do, is solar panels. So the news today. I mean, I won't read the whole RNS because I'm sure you've read the RNS. But the key things I took from this. Um, they're replacing the $115 million RCF with project level debt at Onyx. So Onyx takes on the debt. SDCL no longer has that element of debt. Still has other RCF debt, but we'll talk about that. We see that there's a senior secured facility, so it's obviously a larger facility. So we'll be talking about that. Led by Aptera, we'll be talking about that. We This will reduce future funding requirements whilst having minimal effect on the gearing. So in other words, it's neutral as far as that goes, but obviously saves money at Topco. Just means less profits coming through from the project, but that's okay, and we'll be looking at that a little bit more. Um, we also get a very interesting update, which is to do with something called the platform value. So we'll be talking about that. We also get the news that there's, despite receiving a number of proposals, that due to the uncertain environment, due to the uncertainty, the disposal has proven difficult on acceptable terms. Rather than continue, the investment manager is pursuing selective privately negotiated, so potential for bringing in an equity partner for the contracted portfolio. So what this means is, rather than sell off Onyx, they're thinking about selling off part of Onyx. That's basically it. And a number of parties have been selected to enter into private negotiations. So, and obviously we're doing all of this, or I'm doing all of this without the upcoming annual report. So this is due on the 22nd, 24th, I believe. So this is 2 weeks away, not long away. But yeah, that's the gist of today's news. Also, just whilst we're here, you'll notice that the news from the 5th of June was that the dividend was covered by net operational cash. So once again, I've had one or two people pontificating and saying, "Oh well, what if it's not covered?" Well, there we go. It is. There's the proof. It is covered, and that's been consistently the case. And yeah, I mean, and at that level, 1.58 pence per share when the share is 49.35 pence. That's a dividend of 12.8% at today's price. If you went and bought it tomorrow, when the markets reopen at 49.35 pence, you would get 12.8% or 3.2% per quarter. And if you bought it back when I spoke about it in this article, say it like you mean it, or sometime shortly after, you would have picked it up at 43p. And I've been I've been loading up merrily, at these depressed prices. Where I was convinced that it was mispriced. So far, the rebound has proven that bit out. Yeah, I'm not sure what's happening with all of this because that's obviously not the share price. Be nice if it were 89p. But anyway, we'll see if yeah, there we go. That's better. Oh, well, anyway, that doesn't seem to be working, but that's not me. That's Hargreaves Lansdowne. Anyway, let's get into this article. So, dear reader, the new facility compares to the 51 million of project level debt and the 115 that was announced as being lent from SDCL, from SEIT. So it had 166 million of debt. So what I'm saying is it goes back to this bit here. Look, 51 plus the 115 that was announced in the interim report, total of 166. So today's announcement means that there's a further 94 million of headroom of borrowing facility that's been obtained. Just whilst we're here, the equity value, so the valuation was $378 million back last September. This is the last NAV valuation, and I'll be talking about these megawatt hours as well, and about this EBITDA in a while. So, but you can see here, delivering 5.3 million in 6 months would be 10.6, and 10.6 compared to 378 is a enterprise value to EBITDA of 36 times, which is expensive. So, this has been perhaps one of the reasons why people have said, oh, well, it's not going to get what it's wanting, and it's not worth the money. So blah, 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 blah. Anyway, let's get into that statement. So what we get told today is that the majority or actually no, sorry, this isn't today, but prior to today, in the last update, we get told that 85% of Onyx's value is underpinned by contracted projects. So contracted projects will be they're live, they're operational, they're earning money in a contract. So 85% of that number there is straightforward to assess and value. Okay, but however, a smaller proportion, 15 up to 15% of the valuation, is attributed attributed to its platform value, which is the growth potential and development pipeline. So, in other words, This isn't contracted income. This is prospective income. This is the pipeline of jobs. It's also the projects under construction. So that is valued at 15% of the valuation. So 321 million is 85%, 57 million is the 15%. So 321 is in the bag and 57 is up for debate. You could sort of see this as a sort of, this is the value of the going concern, or the value of the business as, the value of the business as a going concern. And if you were to buy this asset, if you were to buy Onyx Renewables, you would be buying it at sort of $57 million worth of goodwill, which goodwill being the value over and above the value of its tangible assets. It's sort of like it's 57 million of intangible assets, because these relate to the value of the going concern of the business, if that makes sense. If you buy a business, let's say you buy a corner shop, and that corner shop makes 50,000 a year profit. The corner shop has £100,000 of stock, and you pay 200,000 to buy the business. You're paying 100,000 for the assets, and you're paying 100,000 goodwill, because you're buying a business that generates 50,000 a year. Yeah, so that's kind of the way it works with accounting. So to me, 57 million relating to a going concern of this business seems quite reasonable to me. And let's kind of get into why. We know that the bids didn't reach an acceptable level, so didn't reach acceptable terms. But we also know that the value of that platform value reduced during 2025, because more and more came online, but less and less was in construction. If we go back in time to March 2024, the platform value, you can see it here, was 3% versus 12%. So it was 20% of the value of Onyx, whereas at the end of September 2024, it was 15%. So it went from 20 to 15. So 5% of it moved from goodwill to being contracted projects. So the direction of travel is that 15%, we already see proof of, like, say, about 20 million of that 57 in 6 months, turning from goodwill, or going concern valuation, to tangible valuation. Okay, so it would have been maybe 80 million drops to 57 million. So that gives you a good idea of how tangible that intangible is. As far as I'm concerned, that is good. Now, the other thing is, it relates to the pipeline. So what we would therefore want to be able to see is stuff coming out of its pipe. Not wanting to put too fine a point on it. That's what I say here, is the platform value is moving it from construction in progress, so CIP, to operational. It's earning me money. I don't have a boarded up corner shop. I have a shop that is open for business and is making profits. It's making 50,000 a year. If you've got a boarded up shop, you can't expect to earn as much going concern profits, because it's not making money. You open the doors and who knows, perhaps you'll start making money, but presumably you've got to build up your regulars. Okay, so you've also got this well, about 2/3 of it, 25 to 35, relates to the development pipeline between this year and this year. So again, it's taking into account that. So let's look at how it's performed. So the other thing that I thought was very interesting, and it's only when you sort of focus in on things that you kind of realize these things, that in the 6 months to the end of September 2024, remember back here when I said, an EV EBITDA of 36 times, like, that's really expensive. Well, it was, but this number here, okay, this number here, this 5.3 million, was basically a lot lower. So it was a lot lower due to some one-off factors. There was some equipment breakdowns. They had kind of what they call a technical underperformance that caused this. So during 1H24, operational assets performed below budget due to combination of technical underperformance and lower solar resource. However, as a measure of their successful growth trajectory, they have added 14 megawatts of capacity to their operational portfolio during that period. So they all, and as at the end of September, they had exceeded the 70 megawatts notice to proceed. So, I mean, these things don't get built very quickly. I mean, you don't sort of rock up, sort of chuck some panels in a field, hook it all up, press the go button, and it's operational. These things take months and months, and in fact years to build out. I mean, you're looking at something like a 24-month gestation period. So this 70 megawatt notice to proceed, this is all pipeline, okay? Nothing in that 70 megawatts came online during 2024 and 2025 up till today. Okay, well, at least it's very unlikely. Okay, and in fact, we'll come back to what did come online. It's also the case that this 5.3, based upon this many megawatt hours, that there's a way that you can work out how many megawatts generated it. So there's a sort of a formula, which is that, and this is the EPA.gov's formula. So for the USA, for an average solar project, you get something like a 19% efficiency. And therefore, if you take that number, divide it by 1431, that will get you from megawatt hours to megawatts. Okay, so, and it's this bit here, RNREL PV watts. Calculator calculates that number of square meters in a football field, I think they refer to, in Kansas City, Missouri, I think that might be, MO, nothing to do with murders, hopefully, would produce this many kilowatt hours per year. So in other words, 1 megawatt generates 1453 megawatt hours. Is kind of the so that's where I'm getting that number from. So if I take this, divide it by the 1431, I get to kind of, approximately, and these aren't precise numbers, but we get to approximately a capacity of about 95 and a half megawatts in the first half of 2025. So it's that number doubled, because obviously it needs to be annualized, divided by the conversion factor, gives us our annual capacity of 95.5. So just sort of think in context. So that 95, and we've got 70 that's in progress. So we've got sort of this 70 is the growth, future growth, 95 live. Now we also know that in calendar year 2023 that they hit 95% of their budgeted performance, and that they produced 107.9 terawatt hours. And that was based upon 75 megawatts. Now, again, I'm getting that from that number there, divide it by the 1431, and also multiplying it by 95%, so dropping it by 5%, gives me 75 megawatts. Now, 75 megawatts in a good year, when you don't have underperformance of equipment breaking down, generated that much profit. Now, I mean, okay, we don't know that there was not underperformance in 2H25, which is the period up till March 2025, nor do we know from the 1st of April 2025, so in FY26, because that's where we are now. We are 3 months, we're in the third month of financial year 26, which is 1st of April to 30th September 2025, we don't know that there's not problems, but they don't mention any. So I'm going to make the reasonable assumption that there weren't any further problems. We'll know that for sure in 2 weeks' time when we get the annual report, and you'll also get either a complete repudiation of these assumptions, or you're going to get a pleasant surprise, is what I believe you're going to get. Because, I mean, that 75 versus the 95 that we know existed in 1H25, plus 15 megawatts that was added since September 2024. Now again, obviously there's a timing issue here, so it's not going to be absolutely precisely like this, but roughly, I'm just saying roughly what we're talking about here, and these are the three press releases. So December the 23rd, 5.2 megawatts went live. Okay, so this was the Onyx Renewables, North Troy solar project, blah-de-da-de-da, for GE Healthcare. We had another one in February, 4.23 megawatts. This was the US Army, and this was the third phase of the US Army. So they've got two solar energy projects, and now they've got a third that went live. And then a third one, Toyota Boshoku America, TBA, 5.7 became operational. So we know that at least 15 megawatts. Now, those didn't go live on the 1st of October, but equally, I reckon that there's we've got three press releases, which are your three sort of big projects. Is it feasible? Is it likely that there was a load of, like, if you had Joe Schmo that had 0.01 of a megawatt go live, like a really small installation, because not all of these are army barracks for thousands and thousands of like 4.2 megawatts is a sizable development. I mean, that's chunky, as is that one. I mean, Toyota, GE Healthcare, and 650 households. I mean, some of these are going to be sort of the drugstore with a car park with like 30 spaces where they've got like a covering to put the 30 cars in the shade, and they've got solar panels across all 30 carports, and that's your 0.01 megawatts. None of those are going to get reported in the press releases. So whilst it's not all 1st of October, equally there's going to be a load of stuff, like little stuff, that's percolating through and going live. So I don't think kind of saying 95 plus 15 equals 110, and I say likely circa 110 operational platform, I don't think that's an unreasonable number to be using at all. And that number 110, if we sort of prorata that number for that EBITDA, comparing it to the 75 we worked out for financial year 2023, well, guess what, folks? That translates to that translates to, sorry, let me that translates, sorry, yeah, I've skipped it too far. That translates to a 46% uplift compared to 2023. And that sort of 46% translates to a growth of EBITDA of about 20 million. Now, I don't know this for a fact, but I do sort of think it's reasonable that something at or approaching that is, well, if not for the period of 2H25, that here we are in June 2025, so in FY26 today as we speak, that it's at least that level of EBITDA, which is a shed load more than it was before, and the shed load more than the valuation. And actually, if you take that 321 million operational valuation from last September, I mean, you're only then really looking at 16 times earnings, not the 36 that we all, I think, can agree is pretty racy. If you could sell things for 36 times earnings, well, that's almost sort of like a like a sort of .com valuation to something. It's not a sort of so in other words, that valuation was a one-off because of depressed profits in 1H25 that I don't think will have repeated, and certainly doesn't exist as far as disclosures go. So 20 million earnings is, obviously that's a big growth. And the other reason that makes me think that this is reasonable, because you think if you're taking out debt of 260, and I mean we don't know the interest rate, but let's say it's 5%. I mean, for like utility type debt, 5% is probably about what it is. Maybe a bit more. I mean, let's say it's 5%. Your interest payments on that, on 260, would be 13 million, 5% of 260. I mean, you've got to be pulling profits of above that 5%, that 13, in order for somebody to lend you that money. Because why would they? Why would they lend you money if you're loss making after you pay them what they're due? That would just be a bit of a dangerous situation to be in. So again, I think the 20 million is pretty nailed on as far as and if anything, as I say, that doesn't take into account all of the little diddly bits that won't have been released on a press release, and therefore don't get reported. It also is fair to say that the platform cost, I mean, again, is that still 57 when 15 megawatts at least has come through and turned into operational? It was, almost like minus 20 million in between FY24 and 1H25. That dropped by 5%. That dropped by about 20 million. So would it not be reasonable to think that a further 20 million has dropped off it? Again, it's up to you, but it seems to me that that platform valuation could be lower because more is operational. It's logical because that's what they tell us it's based upon. And we can see that there's at least 15 megawatts of stuff that's gone live. And when I say we can see, I mean it's all here under the Onyx news flow. So under here, there's Toyota, and actually I've not even kind of gone into it. That's the army, Fort Riley. We've then got other news flow like I mean, again, none of this really is sort of like in and amongst that well, I suppose that 70 million that's reported. That you've then got this is 40 with Teleon. So this is a partnership with Teleon for 40, which again, I'm just assuming is in progress and not live or operational. And then you've got a second one down here with Sol. So there's other news flows as well, and this thing as well I thought was pretty cool. I mean, I don't suppose it does very much for the bottom line, but they're also doing sort of like a post disaster relief. They're doing a partnership with Footprint, where if you've got hurricanes come in, that there's these sort of mobile solar panels that they can rapidly set up and get going. I mean, that's good for press coverage and sort of giving back. I thought that was a really nice touch. And I also want to talk about something else as well with relation to this. But anyway, let's get back to this. Yes. So, yeah, couple of other things to say. So sort of 20 million and 16 times earnings seems, that, as I say, that seems about right to me. Now, the other thing is this facility gives 94 million of headroom, but when you actually go to the Onyx website and you go to this news here, we learn that yes, it's a 260 million facility that could be increased to 350, which would be a loan, a line of credit, and a 10 million letter of credit. Okay, so actually, what we're talking about here is, and again, this kind of comes back to the value of the platform, which 57 million for the pipeline and for the stuff that's in progress, where we can see that there's two partnerships that exceed that 70 megawatts, and we also see that I mean, logically, you would only take a larger amount of debt if you had a pipeline that justified it. Again, like, somebody is not going to go and sort of like, here's another 100 million just for the fun of it. It would be because you've got a pipeline that is ready to go, that like, basically, we've got the order, we've got the signature, we just need to put the finance in place, and that's where you come in, Mr. Aptera. So I couldn't think who what they were called. So these guys are the people that are loaning the money to Onyx, Aptera, and this is interesting as well. Look at who else Aptera are loaning money to. Apollo, big PE house, Norton Rose Fulbright, project finance, DCD, data centers, the APA power. So Onyx is not alone in being sort of, finding that there's strong growth. There's all sorts of companies that are also loaning money, that are also finding that there's, you've got Long Road, you've got, I think we've talked about Apollo once already, Opal Fuels, we've got Great Bay. There's a bucket load of money going into all of this. In fact, this bit by here, which I'm going to talk about in a minute, there's falling prices that you can see here. You've got sort of installations that are sort of running, sort of very, very, so commercial and utility. So lots and lots of installations. The price of installations is dropping. The PPA, so this is the purchase price, is pretty solid. I mean, at that sort of money, so that's sort of like, in GBP terms, that's above 10 pence, that number there, 10 pence to 20 pence. So if you're getting a guaranteed 10 pence to 20 pence, and I don't know how much you know about solar, but I mean, the cost of solar is like, I've seen examples. If you go on like PV Today, I think is a newsletter I get, and there's utility companies doing deals at like, the equivalent of $3 to $4. So if you're getting 16 to 35, I mean, that's good, profitable business. I mean, you're getting something well above the cost of, and if the cost of the PV system per watt is just above $1, $1.20. I mean, that's basically, that's going to be 1,000 per kilowatt, and just over a million, 1.2 million per megawatt. So, and that's to generate sort of that level of profit with a PPA for multiple years. We don't know exactly how long or how many, but presumably an extended period of time. So so the fact that there's this 94 million extension to the debt suggests that there is, now take that 1.2 million per megawatt and take that from 94, and I think I did it based upon approximately 1, but let's say it's 94, divide that by 1.2. I mean, that's an extra 78 megawatts. Now, we said that in 2023 it was 75 megawatts and it grew to 110. So that debt should get you from 110 to about 190. Okay, 110 plus 78, 109, well, 188 if you want to be picky. And then that obviously gets you to sort of nearly 300. I mean, as I say, there's no other reason that you'd borrow money other than you've got profitable projects that you want to finance. So again, I think all of this is very very positive. That and I make the point. So I've already talked about this now, where Onyx is not a trailblazer here. This isn't some wacky let's build it and they'll come. The fact is they're already coming, and there's BlackRock, there's lots of other smart money that I just showed you on that website that are borrowing money from Aptera just the same. This is something that is an opportunity. And actually, the other thing that's crept into the lexicon today, and I just want to call this out, is the word storage. Let's just quickly touch into this because this has not come up before. I don't think. I might be wrong on that, but I don't think it has. So um, if we do a little look up for the word storage, including on-site solar PV and battery storage. Now, as far as I think everyone is aware, up until today, we have only been talking about PV, solar PV. That's what Onyx was. They do solar PV and that's it. It turns out that they also do battery storage. Now that's interesting because obviously the whole point that's kind of happening at the moment with solar, and the reason that solar is kind of that you get the sort of during the midday sun, the price of energy goes down, and then in the early evening, when everyone wants to uh, uh, put on their kettle and use energy, that you've then got that problem, which of course is happening elsewhere in the UK and elsewhere, that um, the energy is not available when people need it. So the prices in the evening are expensive and the prices in the day are low. Well, if they're including storage, that's another way to be making money. So those PPAs of the 16 to 30, where has it gone? It's sorry, yeah, this this 16 to 35. I mean, perhaps 16 during the day when everyone else is generating solar energy and there's a glut of it, and maybe 35 in the evening when the sun's gone to bed, and like, oh, we've got to put the fossil fuels on and it's expensive. 35. Well, if you've got storage, you can sell it when it's 35 and generate it when you'd otherwise get 16. So um, if through using storage they're getting more towards that number and less towards that number, I mean the profits are going to be far 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 higher. And that's the whole point of solar plus storage, is that the combination of the two is compelling, really compelling, because you can sell the power when it's needed. And obviously these are this isn't sort of behind the meter generation. This is kind of where they are presumably controlling and able to draw down the power and sell it, and the landowner gets some free energy. Onyx, like, the deal is that they don't sell these projects, they keep the projects, and the projects earn them money, but they earn the money that they'll be selling the energy and managing the energy sales. So again, I think the storage piece is a really positive piece of news. I want to kind of touch on something else that I discovered because I thought this was really interesting. So Onyx is run by, if we go to About Us, Onyx is run by Mary Beth Mandanas, Chief Executive Officer. So it says here, Chief Executive Officer of Onyx, previously worked, for sort of Tortoise Ecofin Acquisition Corp. That's a bit of a mouthful. MBA, very good credentials. Worked for Credit Suisse, First Boston City Group before transitioning to renewable energy. Very interesting. But Where else does she work? Uh, She also works in a place called Energy Vault. Well, she works. I mean, she's chief exec of Onyx Renewables. She is the non-exec director of Energy Vault. Who are Energy Vault, I hear you say? Well, let's kind of cover this. Energy Vault, if the name sort of doesn't give it away, is energy storage. So energy storage, where I mean, obviously those revenues are quite small. I mean, that's obviously Q1, so that would be sort of 37 million. But they've got a backlog of 650. They've got cash of 47 million. So could they afford to buy Onyx? You can see where my brain's going here. Um, well, no, not with 47 million. We're not going to sell Onyx to you for 47 million. Thank you very much. But have a look at this. Operating cash flow 16 million. Okay, obviously it decrease 4%, blah de da. 57% gross margin. Um, it's this bit. I mean, obviously the executed projects, the backlog of projects, the development pipeline of projects. But it was this that caught my eye. I mean, these are all the projects. So they're doing stuff in Texas. They're doing stuff in Australia, and you can see these are sort of chunky projects. You know, 125 megawatts, 8.557, 250. You know, this is kind of like a Gore Street Energy type, you know, so that's another OB25 for 25 idea. But yeah, this was the thing that caught my eye, was that during 2025, I mean, yes, they've only got 47 million of cash, but they've got kind of growing cash, that they are cash generative. Could these come on board as a partner and a part owner of Onyx? Chief exec is a non-exec director. It does storage. Onyx, surprise, surprise, is now doing storage. Now, this is sort of BESS. So this is like BES storage rather than sort of attached storage to solar. So it's not quite the same thing. But it seems like an intriguing possibility, that you've got a connection there that would be a kind of a bit of a logical connection, that you would be able to kind of get a synergy going between these two companies. Who knows? But that was interesting as well. This Yeah, I mean, I sort of said 1 million. I didn't sort of highlight that bit there, so I sort of now realize it's 1.2, so I'll change that on the fly. But yeah, so to sort of bring this to a conclusion then, because we've been going 42 minutes, flipping heck. I mean, if you sort of say, well, even just taking a doubling, and as you see, sort of that doubling is kind of a little bit on the conservative side, because that assumes that you'd use up the project finance and then that's it. You get no more money. There's no cash flow generation, you know, like, which isn't realistic. There is cash flow generation, but I can see a pathway that within a fairly sort of reasonable near term, that you could get to an EBITDA of above 50 with this. And, you know, taking that cost of capital that I talked about, I don't know that it's 5%, but I just know this sort of project where it's kind of contracted income, it's very boring. It's what I've said all along. This is a very boring asset with very boring, you know, this isn't sort of racy, you know, cutting edge. This is just sort of generating power, um, and building out utility power. I mean, it like, for it to be discounted as much as it is, I mean, it's like, you know, if this were fusion power and it was on a 50% discount, you could kind of go, well, it's fusion power, it should be on a discount. But this isn't. This is just sort of boring power. And it's power that, you know, now has a pathway to grow to at least a 50 million. And that's not really taking into account any profitability around the storage, nothing around it being at 35 rather than 16 dollars per mega, you know, per unit. I'm taking a 5% cost of capital that takes off, you know, that down to 32.5 depreciation, which is based on 30-year life of 240 million of capex, more or less, gets you to an 8 million a year That gets you to a 25 million net profit on this company. Now, 20 million net profit for contracted earnings over 30 years or over extended number of years. I don't know that it's 30. I don't know how many years, but I mean, 20 times to get you to a 500 million valuation. To me, that seems entirely reasonable. That's not kind of really doing anything other than saying, well, give it a year or two, or maybe three, it'll be on a 500 million valuation quite easily. So, like, when you value valuations, you're sort of forward valuing these things to say, well, you don't buy the pair of shoes that you're going to grow out of in 6 months' time. You buy the pair of shoes that you're going to grow into in a year or two's time. And that's kind of where I sort of see valuing this at 50% above what it's valued at today, not 50% less, 50% more, on the basis that it's got a pathway to growth, is kind of my take on this. I don't know that for a fact, but it seems reasonable. So I just sort of end by saying, well, it dropped as low as, I think it was even like 42 point something, because I bought some at really silly prices, and I must admit, I just cannot believe this opportunity that's presented itself. But even today, at 49.35p, I mean, it's still like 12.8. It's still incredibly cheap. I can see that there's upside in the short term based upon just the 2025 results, and there's plenty of meat on the table. Like, if you've got something where you've got a prospective 500 million valuation, could you get a partner to partner in on some of that stuff? Absolutely, you could. And is there a logical partner there with Energy Vault? Potentially, but there's plenty of other options out there, I'm sure, as well. um, that's what they're looking to do now, which is fine. If they can find an attractive term, then great. That sort of frees up some cash, recycles some cash. If they can't, well, who cares, because this is going to generate growing and increasing profits into a macro where the amount of power that is demanded by, well, even just, I've done articles where I've talked about the data centers. So I mean, this CWR article from a few days ago, Core It's Knockout. I mean, the data center growth, and this is just US data center growth. It's this one here. Look, they can't use gas powered uh, um, um, turbines because the lead time on them's too long. The lead time, I think I put that in this article as well, if I'm not mistaken. Uh, the lead times, and it's this bit where I say don't fall off your chair, is oh, sorry, yeah, lead time somewhere in this article anyway. Yeah, the lead time for yeah, sorry, it was here. So this is all you can see. Revenue up 38%. This is all sort of because of the demand, because of the backlog of orders. Orders have grown for gas turbine generators. Electrolyzers is the only way forward, but obviously, what's going to power electrolyzers? Well, solar. So like, even just this 224 to 606 terawatt hours worth of energy. I mean, if we plug in so 606 minus 224, and we use that magical what was it, 1341, so that's 284 megawatts worth of solar to generate the energy that can then be turned into hydrogen, that then can be turned into energy for the data centers 24 hours a day. So just everything about the US and about energy usage in the US is just heading upwards. So there's a long macro ahead, is, I guess, the conclusion I would come to. And this sort of idea of saying, oh, well, there's a UK listed company called US Solar that's not done very well. Well, that's utility solar. It's completely different. The assets are quite old. There's lots of reasons why comparing that to SEIT is just complete garbage as far as I'm concerned. Um, the fact that the interest costs dropped by 2.5 million, the fact that you've still got a 12.8% dividend even at today's prices means that 52.8% discount. And then if you kind of say, if you agree with the fact that the NAV also includes a whole load of discounted cash flow assumptions that are just discounting the companies at what I term a ridiculous level of, I think it's something like a 9.3% discounted cash flow in discount rate, which I just think is ludicrous for boring utility energy. If you agree with that statement, it's a 52% discount even after the price rise to 49.3p. If you disagree and you think the company, they've valued it perfectly correctly, that discount rate should apply, then you're still talking a 46% discount. So I'm kind of on the working assumption that this 92.5 pence per share NAV, I can see that going to about 105, £1.05. And that's based on the noise, but nothing else. So I'm not like the success that Onyx is having. I'm not assuming that reflects itself into the NAV. Anything. All I'm doing here is that this discount of 43 pence becomes 55 pence when you strip out the 12 pence worth of noise. And this is kind of just taking the increase of discount. So I'm just using a discount from, I think, 2021 or 2022, ignoring the discount noise for the last few years, and that's it. So anyway, that's enough from me. I hope that's been useful. It gives you quite a different take on today's news, possibly. We'll know more when we get the annual results. This is the Oak Bloke. None of this was advice. This is just me talking about a share that I own, and you enjoy listening to me talk, and nothing more. You make your own investment decisions, but thank you for watching. There are a few people watching live, I see. If you wanted to ask any questions, you can ask those of me, or just put them in the thingamajig. But do like the article as well. If you I do appreciate people liking articles. Woodford got 13 likes for one of his videos, so I don't want to have fewer than him, because that makes me look really, really sad. So yeah, do like this, and share it. I mean, it's if you think it's worth sharing, share it. So anyway, that's enough from me. Oak Bloke saying cheerio for now. Cheerio.